And here we are. Welcome to the final installment of our deep dive into the AEA's top 20 papers. It feels really fitting, you know? We started this whole journey exploring the nature of the firm, and we're ending it by tackling the very nature of the stock market itself.
So let's just get right to it with the big one. Is the stock market rational? I mean, all those wild, heart-stopping swings we see, can they really be explained as just logical responses to new information? Or is there something else, something messier going on?
You see, for decades, the answer from the world of finance was a confident yes. The reigning theory was the efficient markets hypothesis. And the core idea here is that stock prices are always basically right. They're seen as these perfect machines that instantly absorb all the information out there to give us the best possible forecast of a company's future earnings and dividends. So if a stock suddenly crashes, hey, it's just the market smartly reacting to some new bad information.
But then, in 1981, an economist named Robert Shiller came along and asked a question that was so simple it was radical. He didn't just want to argue with the theory. He came up with this incredibly clever way to actually put it to the test, using a whole century's worth of data.
Here's his brilliant idea. He created something he called the ex post rational price, which he labeled P star. Just think of it this way. What if investors back in, say, 1871 had a perfect crystal ball? What if they knew exactly what dividends every company would pay out for the next 100 years? What would the stock price have been then? Well, the amazing thing is we can actually calculate that number because we can just look back at the historical record and see what the dividends really were. And this is where it gets really good. This idea lets Shiller set up this incredible, dramatic showdown. He could now plot the actual, messy, real-world stock price right next to this theoretical, perfectly rational price. It was truly a tale of two prices right there on one chart. Okay, so first, let's look at the actual price, the line labeled P. This should look pretty familiar. It's the stock market as we know it, over more than a century. It's jagged, it's chaotic, it's that wild roller coaster ride we've all heard about. And now for the big reveal. Look at this. This smooth line cutting right through the chaos. This is P star. This is the rational price. It's what the market should have looked like if it was only reacting to the real long-term value of dividends. The difference is just, wow, the rational price is so incredibly stable. And it makes sense, right? A stock's value isn't just about next year's dividend. It's about the stream of dividends over decades. And that long-term view smooths out all the short-term bumps. Now, let's zero in on the most glaring example on this whole chart, the Great Depression. The actual market crash was just catastrophic, a complete freefall. But now look at that smooth P star line. The actual long-term damage to dividends? It was just a relatively small dip. The market's reaction was absolutely wildly out of proportion with the real financial impact. But Shiller knew a shocking picture wasn't enough. He had to back it up. So he formalized this whole observation with some rigorous math, turning what our eyes can clearly see into an airtight, irrefutable proof. The logic behind it is actually beautiful and simple. Just think about a weather forecast for a second. The forecast might say it's going to be 70 degrees, but the actual temperature during the day might swing from, 65 to 75. The actual thing, the temperature, is always going to be more volatile than the forecast of that thing. Well, the same exact logic should apply to stocks. The price is just a forecast of future dividends, so the price should be smoother than the reality it's trying to predict. And this powerful idea is captured in what's called the variance-bound inequality. All it says is that the volatility of the actual price, that's sigma of P, has to be less than or equal to the volatility of the rational price, sigma of P star. And listen, this isn't just a suggestion. According to the efficient markets hypothesis, this is a mathematical necessity. It has to be true. So Shiller ran the numbers. What did the data say? Well, it was an absolute bombshell. The inequality was, as Shiller himself put it, dramatically violated. The real stock market wasn't just a little more volatile. It was 5 to 13 times more volatile than the absolute maximum limit that could be justified by news about future dividends. The conclusion was just inescapable. All of those massive, erratic swings we see in the market day to day, they simply cannot be explained by the small, stable changes happening in the underlying business fundamentals. Stock prices just move way, way too much. So if it's not news about dividends, what in the world is causing all of this extra turbulence? Shiller's paper basically forced the entire world of finance to admit that there had to be a missing ingredient in their models. And this is the paper that really kicked open the door for what we now call behavioral economics. It was this powerful argument that markets aren't just driven by cold, hard data. They're driven by us, by human psychology, by fads, by social pressures, by huge waves of optimism and pessimism, what the great economist John Maynard Keynes once famously called animal spirits. Shiller's work proved that financial markets are so much more complex and, frankly, so much more human than those old, simple models ever suggested. And this very idea that our economic models have to account for the weird, wonderful complexities of human behavior is a theme that has popped up again and again in our series. Which brings us, finally, to the end of our journey. I mean, think about where we've been over these 20 explainers. We've traveled all the way from the very nature of the firm with Ronald Coase to the very nature of the market right here with Shiller. We've dug into why some countries get rich while others stay poor, how information works, how people make choices. It's been an incredible tour of big ideas. And if there's one single lesson to take away from all of it, it's this. Economics is so much more than just money. It's really the study of incentives. It's about the flow of information, the puzzles of organization, and at its heart, it's about the beautifully complex and sometimes irrational machinery of human choice. These 20 papers answered some of the biggest questions of their time, and in doing so, they opened up countless new ones. They built the foundation that economists are still building on today. And that just leaves us with one final thought to chew on. What are the great economic puzzles that the next century is going to solve?